Warren Buffett once said, "I don't have emotions about stock prices." And honestly, that one line says a lot about why he's one of the most successful investors in history. In today's video, we're taking a closer look at a powerful moment from the 2025 Berkshire Hathaway annual meeting. You're going to hear Buffett explain, in his own words, how he stays cool when everyone else is panicking, and why that mindset has made him billions. Right after I show you the clip from CNBC, I'm going to break it all down, line by line, and give you my personal reaction to what he said. And then stick around, because I'll also reveal one Buffett-backed stock that I believe could absolutely explode in 2025. If you only watch one video today, make it this one, and make sure you watch all the way to the end. Smash that like button. Let's try to hit 1,000 likes on this one. Drop a comment below with your thoughts. And don't forget to subscribe so you never miss another big investing insight. Alright, let's hear what Warren Buffett had to say.
Dear Greg, dear fellow owners, it's such a pleasure to be here. My name is 𝗣𝗟𝗏𝗦𝗧. I was born in communist Albania, but I'm now teaching economics in London, England. The wonderful writing of Warren and Charlie has significantly shaped my thinking and teaching. I thank you both very much for the many insights over the years. Warren has often written about the importance of Berkshire's earning power to owners. My question is, what was, in your estimate, Berkshire's earning power in the latest fiscal year? It would be great if you can comment on any significant items that either increased or decreased the earning power as compared to reported net income measures for Berkshire. Thank you.
Yeah, well, I think our underlying earning power was affected negatively here a while back by what happened in the utility field. I think that our earning power was not enlarged by any large acquisitions that come along, but they come along periodically. So we will see something at some point that could be, on the one that was $10 billion, we would have added to earning power. I mean, why else would we do it? That's very situational. And of course, it depends so much on what the general market is doing and what interest rates are doing and what psychology is doing. We will make our best deals when people are the most pessimistic. That's been true ever since I was 1930. I was born in 1930. When I was born, things got much more attractive over the next 2 years, and apparently I didn't do anything about it there. But, that was the opportunity of a lifetime, and I blew it by, worrying about the kid in the next crib or something. But over my lifetime, I've had fabulous opportunities sometimes, and they happen because humans are human, and I don't. I'm fearful of all kinds of things. I don't want to try and, be one of the Walendas and walk on a tiny strip between a couple of twin towers or something, or whatever it may be. But I don't get fearful by things that other people are afraid of in a financial way. That the idea that if let's say Berkshire went down 50% next week, I would regard that as a fantastic opportunity, and it wouldn't bother me in the least. And most people aren't. They just react differently, and so it's not that I don't have emotions, but I don't have emotions about the prices of stocks. I mean, those decisions get all the way to my brain, whereas emotions can get bogged down some other place. So Berkshire will increase its earning power over time as we retain money. I mean, we are doing things, making decisions every day. People are working, we're retaining earnings. We will build the earning power, but it won't be coming in any even stream, and it certainly won't be matched dollar for dollar on either the upside or the downside. And market prices and But that's what makes it a good business. And, the investment business is that everything isn't properly appraised, and the sillier other people get, the better your opportunities get.
Before I give you my reaction to Buffett's interview and reveal the one Buffett company stock that could go parabolic this year, let's talk about your financial journey. If you find this analysis valuable, support us by liking, sharing, and subscribing. We've created the Value Stocks Investing Master Course, a step-by-step guide to identifying undervalued gems and building a resilient portfolio. Whether you're new or experienced, this course is your roadmap to financial independence. Join our community of informed investors and take the most important step toward your financial future. Click the link in the description and pinned comments to get the course today and take control of your financial future. Now let's unpack Buffett's comments line by line, look beneath the surface, and explore the big picture ideas that make his investment philosophy so timeless. So first off, the question came from 𝗣𝗟𝗗𝗗𝗘, who has a fascinating background. Born in communist Albania, now teaching economics in London. He kicked things off by acknowledging the profound influence that Warren Buffett and Charlie Munger's writings have had on his life and career. And honestly, that's something I think many of us can relate to. Their letters and speeches are more than just financial advice, they're a window into how to live wisely. His question was simple, but incredibly important. What is Berkshire's true earning power in the most recent fiscal year? And just as importantly, were there any major factors that distorted that figure compared to the reported net income? Now this is where Buffett starts getting into the heart of the matter, and as usual he doesn't give a direct number. But that's kind of the point. Buffett emphasizes that Berkshire's underlying earning power is the real story, not just the number printed on a financial statement. One of the first things he mentions is how their earnings were affected negatively in the past year by challenges in the utility sector. And this is classic Buffett. He's never afraid to point out where things didn't go well. But he also frames it as part of a broader, more dynamic picture. He makes it clear that Berkshire's earnings aren't being supercharged by any massive acquisitions this year. Sometimes a $10 billion deal might come along, and when it does, it can boost earnings power. But it's all situational. It's not something they chase recklessly. Instead, they wait patiently for the right opportunity. Now here's where it gets vintage Warren. He talks about how the best deals come when the market is at its most pessimistic. He jokes about being born in 1930 during the Great Depression and says, "I blew the opportunity of a lifetime by worrying about the kid in the next crib." Classic Buffett humor, but with a point. Markets are driven by human emotion. And because humans are emotional, markets become irrational. That irrationality, that fear, is what creates opportunities for investors who can stay calm and think clearly. This is such a central theme in Buffett's philosophy. Be greedy when others are fearful. Be fearful when others are greedy. And that's not just a cute saying. It's how he actually makes decisions. He doesn't get emotionally attached to price fluctuations the way most people do. He even admits, it's not that I don't have emotions, but I don't have emotions about stock prices. And that's key. He's not saying he's a robot. He's saying he's trained his brain to separate emotions from market noise. So when he says, if Berkshire went down 50% next week, I'd see it as a fantastic opportunity, he really means it. Most people would panic. They'd sell. But Buffett would be ready to buy. Because he knows the intrinsic value of the business hasn't changed. Only the market's mood has. Next, Buffett circles back to the idea that Berkshire will grow its earning power over time by retaining earnings and reinvesting wisely. This is long-term thinking at its finest. He makes it clear that this growth won't come in a smooth, predictable stream. Some years it might jump, other years it might dip. But the trend, over decades, will be upward, because they're constantly making smart decisions behind the scenes, day in and day out. It's like planting a forest instead of chasing fireworks. And then he drops another gem. The investment business is great because everything isn't properly appraised. The sillier other people get, the better your opportunities. That's the essence of value investing right there. The stock market isn't efficient all the time. It overshoots, it panics, it gets euphoric. And those moments of silliness, that's when Buffett steps in. That's when he gets his best deals. So what did we really learn from this short clip? We learned that Buffett doesn't get caught up in the daily headlines. He doesn't obsess over quarterly results or worry about what the market is doing minute to minute. He's focused on earning power, the ability of a business to generate cash over time. He's also someone who embraces volatility. While the average investor sees it as risk, Buffett sees it as opportunity, because when the crowd panics, prices fall below value, and that's where he makes his move. This interview was a perfect reminder of the mindset that separates average investors from great ones. Patience, discipline, emotional control, and above all, the ability to think long-term in a world obsessed with the short-term. If this breakdown helped clarify Buffett's comments for you, drop a like and let me know in the comments what stood out to you most. Did any part of his philosophy resonate with where you are in your investing journey? Make sure you subscribe for more breakdowns like this, especially if you want to learn how to think like the greats, not just follow the crowd. Thanks for watching, and I'll see you in the next one. Now let's dive into the one Warren Buffett stock that could go parabolic in 2025. The company is Ally Financial, ticker symbol ALLY, a digital banking leader and the largest prime auto lender in the U.S. Ally's online-only model means lower costs and better rates, attracting a loyal, tech-savvy customer base. Its two pillars, a dominant auto finance operation and a fast-growing, direct-to-consumer banking platform. Berkshire Hathaway began building a position in Ally in 2022, now owning nearly 10%. A major endorsement. Despite its strengths, Ally's stock trades about 37% below its highs due to recent macroeconomic pressures. But these challenges have created a prime entry point for new investors. The market's focus on short-term headwinds may be missing the powerful catalysts now aligning for Ally's next era of growth. Why is Ally at a pivotal turnaround point? Let's look at the challenges. The Fed's aggressive rate hikes raised Ally's funding costs, squeezing its net interest margin. Higher rates also pressured consumers, leading to more auto loan delinquencies and charge-offs. Ally had to set aside more capital for potential losses, further hurting profits and spooking investors. Meanwhile, much of Ally's loan book was locked in at lower rates, so asset yields lagged behind rising deposit costs. The result, compressed margins, falling earnings, and a stock price hit. Management paused share buybacks to preserve capital. But this period of difficulty has set the stage for a powerful recovery. The market may be missing the significant positive shifts now underway. The narrative around Ally Financial is undergoing a remarkable transformation. After a period marked by uncertainty and headwinds, the company is now positioned for a significant rebound. There are three powerful catalysts at play, each contributing to what could be a breakout year for Ally in 2025. The first catalyst is the resurgence in Ally's auto lending business. In 2024, the company tightened its underwriting standards, focusing on higher quality borrowers and more robust risk assessment. As a result, the new auto loans originated this year are performing far better than those from previous years. Delinquency rates are dropping, and the overall credit quality of Ally's loan book is improving, setting a strong foundation for future growth. The second major driver is the macroeconomic environment. With inflation finally cooling after a prolonged period of elevated prices, the Federal Reserve is widely expected to begin cutting interest rates. This shift will directly benefit Ally by reducing the cost of its deposits, which are a major expense for the bank. Lower deposit costs mean Ally can improve its margins and become more competitive in the lending market. In anticipation of this, Ally has already started to shed its most expensive depositors, those who require higher interest payments. By letting go of these costly accounts, the company is accelerating its cost reduction efforts, streamlining its balance sheet, and positioning itself for greater profitability as rates fall. The third catalyst is a shift in the composition of Ally's loan portfolio. As older, low-yield loans mature and roll off the books, they are being replaced by new loans with much higher yields. This transition is steadily increasing Ally's average asset yield, which is a key driver of revenue for any bank. The combined effect of these changes is a dramatic expansion in Ally's net interest margin, the core engine of bank profitability. As margins widen, the company's earnings power grows, creating a virtuous cycle of improved performance and investor confidence. Importantly, these aren't just theoretical improvements. Management has been transparent, providing clear and compelling data that show these positive trends are already underway. The groundwork for a turnaround is being laid in real time, and the numbers are starting to reflect that progress. As these catalysts continue to gain momentum, the impact on Ally's bottom line could be substantial. Analysts are beginning to take notice, and there's growing optimism that the company's earnings will rebound sharply in the coming quarters. Yet despite these positive developments, the broader market seems to be overlooking Ally's recovery story. This disconnect between fundamentals and market perception has created a unique window of opportunity for savvy investors who are willing to look beyond the headlines. If these trends continue, 2025 could be the year Ally's stock experiences explosive growth. For investors seeking a turnaround story with real momentum, Ally Financial is shaping up to be one of the most compelling opportunities on the market. At first glance, Ally's valuation might seem steep, especially when you notice its trailing price-to-earnings ratio sitting at 26.30. For many investors, a PE that high can be a red flag, suggesting the stock is overvalued compared to its recent earnings. But it's important to dig deeper and understand what's really driving these numbers, rather than just taking them at face value. The reality is that this elevated PE is largely a result of temporarily depressed earnings, caused by a series of recent headwinds. With a market cap of $11.22 billion, ALY isn't exactly a small player in the financial space. In 2024, they posted revenue of $16.37 billion and brought in a net income of $668 million. That gives them an earnings per share of $1.38, which may seem a bit high at first glance, but context matters. Right now, ALY's stock is trading at around $36.30, which is a significant discount, about 37% below its estimated fair value of $49.83. That kind of undervaluation could be signaling a strong opportunity for long-term investors who believe in the company's fundamentals and future growth potential. If the market begins to reprice ALY closer to its intrinsic value, there could be considerable upside ahead. Over the past year, ALY has faced challenges like rising interest rates, increased credit losses, and a more cautious consumer environment. These factors have weighed on short-term profitability, making the current valuation look artificially expensive. But if we look back just a few years, the story changes dramatically. Before the pandemic, ALY was consistently generating around $2 billion in net income annually. This strong performance highlights the company's underlying earning power when economic conditions are more favorable. It's a reminder that short-term disruptions don't erase long-term potential. If ALY can return to those pre-pandemic earnings levels, its forward PE ratio would plummet to just 5.5. That's an incredibly attractive valuation for a company that's a leader in digital banking, especially when you consider the growth of online financial services and ALY's strong brand recognition in the space. This is exactly the kind of deep value opportunity that legendary investors like Warren Buffett look for. Buffett has always favored companies with strong fundamentals that are temporarily misunderstood or undervalued by the market. ALY fits that mold perfectly, offering both stability and the potential for significant upside. As the economic environment improves, net interest margins are expected to expand, and credit costs should gradually normalize. This will likely lead analysts to revise their earnings estimates upward, reflecting a more accurate picture of ALY's true earning power. The market often lags in recognizing these shifts, creating a window of opportunity for savvy investors. The transition from a high trailing PE to a much lower forward PE could act as a powerful catalyst for the stock price. As investors realize that ALY's earnings are rebounding, sentiment could shift quickly, driving the stock higher as the valuation gap closes. For new investors, this disconnect between current valuation and future potential represents a compelling entry point. It's rare to find a digital banking leader trading at such a discount to its normalized earnings, especially in a sector poised for long-term growth. As ALY's earnings recover and the market catches on, the stock could experience significant multiple expansion, leading to exponential gains for those who recognize the opportunity early. In the world of investing, moments like this don't come around often, making ALY a stock worth watching closely. Beyond capital appreciation, ALY offers a solid 3.31% dividend yield, attractive as rates decline. Management paused dividend hikes and buybacks to preserve capital, but this is likely temporary. As earnings recover, expect dividend growth and the return of share repurchases. Buybacks reduce share count, boosting earnings per share and shareholder value. The combination of stock price re-rating, growing dividends, and buybacks creates powerful compounding. Investors who act now position themselves for multiple avenues of return. ALY's management is committed to rewarding shareholders as the turnaround takes hold. The stage is set for a multifaceted pathway to long-term growth. Spotting turnaround stories like ALY requires skill and a forward-looking mindset. To master this, check out our Value Stocks Investing Master Course, your blueprint for finding undervalued companies. For deeper insights, join our exclusive Patreon community for premium content and early stock picks. Connect with our team and other serious investors, and get the tools you need to stay ahead. Investing is a marathon. Continuous learning and high-quality information are key. Use our resources to invest in your most important asset, your financial knowledge. Take control of your financial future today. We've explored ALY's journey from recent struggles to the powerful catalysts set to ignite growth in 2025. Improving loan quality, falling deposit costs, and rising yields are converging for a dramatic earnings recovery. Berkshire Hathaway's endorsement underscores the deep value hiding in plain sight. ALY is a market leader trading at a discount to its normalized earning power, with a forward PE as low as 5.5. Add a solid dividend and likely buyback resumption, and the total return potential is compelling. What do you think? Is ALY your next big winner for 2025? Share your thoughts in the comments. If you found this valuable, share and subscribe for more deep dives. Thanks for joining us. See you in the next article.